I do think the broader issue with lenders and those that are trying to manage risk and return expectations, particularly around assets and liabilities, is that they've seen this huge shift in rate in a way that really is unprecedented with the Fed. So the implications of that are, if your business model was not resilient to that type of rate change at that speed, did that present something that you didn't expect in your business model? I think that was the case with Silicon Valley Bank. Now, Silicon Valley Bank, we have very limited exposure to them. It wasn't a big deal for us, but certainly I think that the questions that are getting raised then about Silicon Valley Bank are, where is sort of the liability and asset matching, and where is the duration risks, and where is the rate return expectations that both their depositors and then ultimately the assets return potential. Where does that all sit, and what liquidity concerns are out there? And that's the broader point, I think. And that's not just true, as you say, about banks. That's true of private equity. Where's refinancing risk going to rise over the course of the next 2 to 3 years with rates being this high? How's that going to affect exits relative to where the multiples are? So I think everybody is going through this period of disorientation based on how rates have impacted both liquidity, return expectation, and ultimately exits. From our standpoint, the banks are actually really well positioned. I've met with many of the banks over the course of the last couple months, and they're very excited about the fact that they're in this great position. And so they should be much more than the GFC capable of really providing a real opportunity to lend, frankly, and make some really good money doing so. But I think what's getting in the way is this fear of sort of what is that outcome 5-6 months out, relative to where the rate goes for the Fed, relative to where spreads go. And so for them to commit capital, that ultimately results in a closing of a deal, 9 months from now or 12 months from now for regulatory, it's just something that they're not prepared yet to do. And that's why the direct lenders are still, the capital choice provider for buyouts today, and will be, I think, until this gets more settled.